All right, so hello, boys and girls. In this live stream, we're going to be going through around the Melbourne property market. Look, long story short, what we're going to be going through while I'm waiting for that to be set up is I'm going to be going through all around the Melbourne property market. I'm going to be going through around some of the lagging measures and show how it's been performing recently, deep diving into Melbourne's property market over the recent history, also going through the leading indicators, showing what is likely to occur for the next period of growth or even decline if that's the outcome. We'll go through supply and demand metrics. We'll go through some migration trends, and we'll go through what's happening across some of the regions across Melbourne's greater LGA. I'm going to go through some of the common pitfalls investors make when they're buying in Melbourne as well, and what the numbers are really saying beyond the headlines and chat in the property forums and all that sort of stuff. So lastly, I'll go through a bit of a case study and we'll talk about how that market actually fits as well into an investment strategy. So look, without any further ado, let's kick off. As I discussed, is the hype for real? Let's have a look at the Melbourne property market in terms of leading and lagging indicators. Bit of a advice disclaimer here. What I do want to detail to you is none of this is financial advice. Please bear in mind your personal financial situation, and none of this pertains to anybody's specific investment criteria or goals or objectives. Please bear that in mind as we navigate through this data as well. Unfortunately, it seems like I'm having trouble streaming to the Australian Investment Property Network. I'm not too sure what the story is there. But look, as discussed, we'll go through a deep dive into Melbourne's historical property performance. We'll go through some of the leading indicators and what they give us an indication of what the forecast is like. We'll go through supply and demand metrics, migration trends. We'll look at what's happening across Melbourne's surrounding regions and commuter belts. We'll go through some of the pitfalls that investors make when buying a home, and then we'll go through some of the numbers as well beyond what the headlines are saying, and we'll even go through a case study at the end. So look, here is what some of the leading lagging measures have been like around the grounds. Melbourne is down minus 3.2% over a 12-month basis. It's the leading loser in terms of capital cities. The next biggest loss is Canberra at 0.9% when we look at a 12-month basis. By comparison, Sydney is still up 1.1% here. When we look at the hedonic performance from the CoreLogic reporting, this is essentially the 3-month rolling growth that has been split into bottom 25, middle 50, and top 25% when we look over a quarterly basis. Now, Melbourne's top 25% is down 1.6% over the last 3 months to February, 0.7% in the middle 50 and 0.7% in the bottom 25 as well. So when we look at where the biggest loss is occurring, it's at the biggest end of town. It almost makes sense if we have a look at that affordability crunch. Naturally, we want to understand that, in a period of high inflation, high interest rates, and low affordability, more often than not, what's going to happen is the biggest end of town are going to feel it. And that's where we're seeing the biggest losses. In comparison, if we have a look at some of the other capital cities, it's the lower end of town that are performing the best in Brisbane, Adelaide, Perth. More notably, parts of Perth, the big end of town in terms of Perth, have started to come down. Hobart is the big end of town. The top 25% is the only demographic that is posting a loss there in Hobart specifically. And Canberra, again, the biggest end of town, are down 1.7%. So Sydney and Melbourne across the board over the last 3 months, they're all making losses in comparison to Melbourne there. Now, if we have a look at the rolling quarterly performance, okay, you can see here Melbourne has had somewhat of a double dip over the last rolling quarterly changes. You can see here towards the end of last year, it sort of came down to a bit of a trough and then came back down again that's probably the middle of the year, and then we approached the end of the year. So it came back down again, and it looks like it's starting to swing back slightly. But again, look, past performance doesn't indicate future performance. There are plenty of indications here where we've had double troughs, where it's peaked, and then come back up and peaked again. So please bear that in mind. Again, past performance does not indicate future performance. Just because the trend is coming down doesn't mean it will continue to go down. Just because it has gone down doesn't mean it will come back up again. Typically, property does move in cycles. And that being said, don't solely look at past performance. It's probably important to note Melbourne dwelling values are 6.4% below their record high, which was in March 2022. Over the last month, we can see that Perth dwelling values are up. Over the quarter, we're down 1.1, and over the year, we're down 3.2% over the last 12 months. If we have a look at the specific regions where the biggest losses have been occurring, you can see around the Mornington Peninsula there and right along the coast, we're seeing losses greater than 10%. Okay, and then over towards the east, we're actually seeing some of the gains, where typically we'll see some of the more lower socioeconomic or lower value properties be available. There's also a bit of a belt there in the north as well. And then I've been seeing on the property forums a fair bit that there's been a lot of investment in Geelong. Geelong's fairly patchy in terms of its capital growth. So that's important to note. If you're just investing in any particular area, please bear some of these past performance metrics in mind. Typically, we don't gauge future performance based on past performance, as I've detailed. What we use past performance is we use it as a benchmark. So if we want to understand where our property sits in comparison to the performance of other markets or even your market, then we have a look at those performance metrics to give us a benchmark in terms of how well our particular property is tracking amongst the market itself. So that's important to note there as well. I've heard some people looking at regional investment, particularly in Ballarat. Ballarat is facing some similar, troughs here. We can see losses of up to 10% in parts of Ballarat. And then I'm even hearing about some regional investment into regional Victoria as well, purely because of the yields. But look, be that as it may, this is the state of the the markets within the Melbourne LGA or Greater Melbourne LGA. If we have a look at some of the leading metrics now, if we start to have a look at how the days on market are trending or how they're performing, one thing that is important to note is that the days on market for Melbourne have actually been increasing year on year. So if you have a look at this time last year, we were at 42 days in the Melbourne property market. We're now up to 51 days. So things are taking longer to sell. Property listings are remaining longer on the market, which is a leading indicator that there is less demand in the property market as well. If we have a look in comparison to probably Melbourne's closest rival, which is Sydney. So Sydney has had a similar trajectory in terms of days on market. They're up 10 days, not quite as long. They're at 48 days now, but nonetheless an increase of 10 days from 38 this time last year. The two other poorer performers have been Hobart, which is almost up 20 days from 38 to 56 this time last year to now, 56 days. Darwin is relatively stable, 65.5 to 66 days in terms of median days on market. And the only other nation to have a big decline is Canberra, from 67.5 days down more than 12 days to 55 days now. So apart from that, if we have a look at some of the other performers, Perth probably the most notable here because of all the hype and the boom that we've been seeing in Perth. The biggest notable performance there is from 10 to 19 days. So things slowing down almost literally in terms of buyer demand in Perth. If we have a look at the median vendor discount, more notably, we're having a look at Melbourne. The data is all about Melbourne tonight. We are down 0.5%, so bigger discounts on average, 3.2 to 3.7. The next rival is Sydney, 3.1 to 3.5, so an increase of 0.4, still around that same realm. If we have a look at Perth, by comparison, the Perth discount rate is in the same trajectory, so 2.5% up to 3.2%. Okay, so getting close to the sort of average if we want to call it that, of median vendor discount, where the nation is 3.6 and the combined capitals is 3.5% discount there as well. If we want to look at how the trend of property listings and the age of those property listings, this is a great data set that SQM Research provide. We can see that there's a bit of a peak that has been coming up over the last year. We can see more newer properties probably towards the end of last year, peaking for the longest period up until late 2021 there. So you can see that predominantly the under 30-day property listings have come up, and then you can even see the 30 to 60-day property listings come up as well, and then a gradual trend in the property listings that are over 180 days there. So again, a big indication that both the number and the length of time that properties are remaining on the market is there in Perth as well. So the leading indicators is that supply and is up, and demand is down across Greater Melbourne. If we have a look at the vacancy rates, similar story, although we do have those, those natural vacancy rate peaks at the tail end of every year around the December, January period. We've just come off one of those peaks in January, where you can see there that the vacancy rate was approaching 2%, if not more than 2% there. And then the number of property listings vacant were up there. Nowadays, we're looking at around about that 1.5 to 1.6%, which is, it's greater than the Australian national average. So when you are looking at Perth, the average vacancy rate across the Greater Melbourne area is actually greater than the national vacancy rate average. Okay, so consider that when you're looking to put tenants in place into an investment property, that typically it's going to take longer than usual because there's a greater vacant supply of investment properties of which tenants have to choose from. So that's probably most important to note there. And this is telling us the same story. So not only is it telling us the number of listings, but the age of those listings as well. So you can see typically those listings are in the 30 days or less. We're also seeing a bit of a spike in 30 to 60 days, and then a gradual spike in 60 to 90 and 90 to 180 days there. So it's important for investors to note that you could be waiting that typical amount of time when it comes to putting a tenant in place. Now, vacancy rate is important because vacancy rate is actually a hidden cost. So the longer your property is vacant, naturally to say, is you don't get any income. So it's not naturally an expense. It's more of a hidden cost that you take off your income. And so that being said, it's difficult to account for that. So you need to be a little bit more wary around that as well. As we look into the population growth forecast for the Melbourne area, we can see there that we've got a somewhat of a declining natural increase over the next period. We can see that there's a few different series of forecasts from the ABS here, where they're indicating that the natural increase in population, depending on the low, medium, and high, so think of it as conservative, moderate, and somewhat aggressive, is tipped to decline in terms of the natural increase, where eventually, here is being ultra conservative, where they're actually seeing the natural increase to decline in the Melbourne market, and the majority of the population is going to come externally over that period as well. We can see the moderate and high expectation series there, that 40,000 per year on average will come into Victoria as a whole as well. In terms of sorry, just let me pick up my data here. In terms of the where the actual dwellings are going and where the development applications are coming from, we can see that I'm just going to pull up some data here around the number of development applications in Victoria. So if we have a quick look here at this data, now this is again, housing development data. So go to housingdata.gov.au. You can pick up this data free. There's a whole bunch of dashboards that you can have a look at here. In terms of the number of development applications across Victoria for the last financial year period, so up to June 2024, you can see here that more obviously than not, then the majority of development applications have been in and around that Melbourne CBD area there. Bear with me as I just sort of scroll into here. Okay, so you can see there that the majority are around that Geelong, Greater Geelong area. We can have a look in here that Wyndham and Melton have received the greatest number of development application. Now, the reason why I like this data is that you can understand that overall, in comparison to the 50,000 approvals across Melbourne, that the majority here, according to this heat map, are in these areas. So you can even just zoom over. So almost 10% of the dwelling approvals over that financial year period have been in Melton, being almost 4,500, and even the breakup, the majority of those being houses, and then the minority being in townhouses as well. So that's probably one of the things that's important to note. This is a good indication of the household income, so it gives you a rough understanding of what the mean weekly income per household is across Victoria, and also gives you an understanding of where that's occurring. This is a great heat map that will tell you where the population change has been, and that way you can forecast the areas in terms of population change. And then this is very similar to the data that I was showing you previously around, what the expected population is for Victoria overall. As we move into those areas, this is just the same data in detail. So again, looking at the overall Victorian area, 51,000 total. That's a makeup of 33,000 houses, 10,000 townhouses, and 7,500 apartments. So look, rule of thumb for me is if there's a development application in place, then 12 to 18 months later, you're going to see a dwelling there. Okay, what the actual breakup of those dwellings is here. And in terms of number of actual dwellings, well, that's a little bit more difficult. You'd need to deep dive into those areas to understand, okay, how many dwellings in that 1 or 2 story block, in that 3-story block, 4 to 8 story block, so that you can get to understand the supply on the market as well. There's been a lot of talk about land tax, and I want to go through land tax as it compares to other areas. So, look, Victoria's maximum general land tax rate is 2.65%. This is PwC data that's been compiled as well. So this is from 1 January 2025. On top of that, there's an absentee owner surcharge, which is an additional 4% that applies to all landowners that are absentee. There's a vacant residential land tax rate as well, which is an additional 1% on top of that. So this is land across Victoria that's left vacant for more than 6 months. In addition, there is also Airbnb tax, which isn't essentially a land tax, but it's more of a surcharge. And then this is the COVID debt levy on top of that as well. So this is all important to note when looking at purchasing. And even I've seen a few people look at buying house and land packages, or even land to build. This is important to note when you're looking at purchasing land in Victoria, let alone Melbourne. This is the general land tax rate. So look on land tax, the taxable value of the land tax, it's nil up to $50,000. The next benchmark is $500 for 50 to 100. 100 to 300 is 975, all the way up to the 2.65% maximum general land tax rate. This is a case study that I wanted to go through. Now, I'm picking on Geelong because I've seen a lot of people in the property forums look at purchasing property in Geelong and investing in Geelong. So for that reason, I've picked this on-market listing that's for sale for a listed sale price of $895 to $965. Now, I've assumed a purchase price of $920,000, and this property has an estimated rental yield. According to the gross rental yield of the area, it's 3.5%, which is, it works out to be $620 per week. Now, if I take into account the sort of estimated council rates of $2,000 per annum, the the land tax based on the land value of this property at 975. Excuse me. And the estimated water rates of about $1,000, as well as the landlord home and content. So I did a quick premium calculation. I think I just used Terry Shear for this one, which is one of the cheaper insurance premiums as well, of $2,100, and property management costs of 8.8%, which is fairly moderate, considering and not taking into account any admin or anything like that. And then finally, interest only loan repayments based on 80%, which works out to be 3680. This property has a net before tax annual loss of $20,855, which actually works out to be a loss of $401 per week. So, look, that being said, your property has to grow in value by at least 3% every year just to make up that deficit, not taking into account any negative gearing, any tax deduction on your negative gearing. So, look, let's say, for example, your average rate of tax is 30%. For that $20,000 taxable loss, you're probably looking at what's 0.3 times that? You're probably looking at a tax saving of about 6,000 on that. So, look, that being said, you do need to consider that loss. So you're probably making an overall loss of about $15,000. So you need to be making that year on year in terms of growth for this to be worthwhile. And then the other thing as well is you need to be able to supplement $400 a week. So you're looking at a medium to high income earner that can afford this sort of deficit on a weekly basis. And that's assuming they're paying interest only. In addition to that, look, you have to stump, in a lot of cases, if unless you're paying LMI, you have to stump up your 20%, which is going to be $18,000, 18,400, based on a 20% purchase price, and sorry, 184. Uh, it's yeah, $184,000 based on the 20% purchase price, and then about $20,000 in stamp duty, or more than $20,000 in stamp duty rather. So you're probably looking at more than $200,000 in cash savings. Now, look, this area is you typically, we want to ensure that people are able to afford to rent this property. So in terms of the demographics of this area, there's a median weekly household income of 1,658. So look, as a tenant, when you're paying $620 per week, it's probably on the borderline affordable, unaffordable level. So look, typically I use a benchmark of 30 to 40%. If it's less than 30%, then it's affordable. If it's more than 40%, it's borderlining on unaffordable here. So we're at a rent to household income of 37%. Now, in terms of ownership, and now this is important as well because we want prospective property purchasers to be able to afford to buy in the area, because that's eventually, if you're looking to sell down the track, this is who we're going to be selling to. So the affordability based on ownership, and now this is only taking into account P&I mortgage repayments, not any of the other council rates, water rates, ongoing maintenance, whatever. This is only taking into account P&I mortgage repayments. So principal and interest mortgage repayments based on a 6% loan for 30 years is $1,018 per week. So when you see that they're contributing more than $1,000 in comparison to their $1,660 weekly income, that's more than 60%. So this is considered unaffordable because you're contributing more than your actual you contribute more than half of your weekly income, more than 60%. And you've got to think, you've only got that 30-40% to meet your cost of living expenses as well. So that being said, it may be difficult for people to afford this property down the track. And for me, that doesn't leave much room for growth because it's an unaffordable property to purchase based on the median weekly income for that particular demographic as well. So look, these are some of the things that we take into account when we're looking at purchasing property regardless. So look, that being said, that comes to the end of our webinar. If you do have any questions, I've got one or two pieces of feedback, so thank you very much for your feedback along the way. I will, definitely appreciate any feedback or any questions. But if you do want to reach out to talk about your specific investment property purchase, then I'm more than happy to do that. Again, I'm not a licensed financial advisor, so there's no specific advice in this. Please go seek a financial advisor for specific financial advice on your goals and objectives. Go see a mortgage broker for your lending. Go see an accountant for any tax advice, and then definitely see a property lawyer for any legal or legal aspects of property purchases as well. So apart from that, apart from the specific property asset purchase process, go see those financial service professionals. Otherwise, I'd love to be able to help you out. If you do have any questions, please reach out to me using my mobile 0404 867 996 or my email gianni@leveragepropertyadvisors.com.au. Thank you very much, guys, and have a great night.